Daily Energy Report podcast. Welcome back to the Daily Energy Report podcast. I'm your host, bringing you the stories that are moving oil markets, shaking up the energy sector, and reshaping the global power balance. Today is April 30th, 2026, and we've got a packed show. U.S. shale production might have peaked. Yes, you heard that right. Gasoline inventories are scraping the bottom of the barrel. China's energy strategy is paying massive dividends while everyone else scrambles. And we'll break down why that diesel shortage article about India is complete nonsense. Let's dive in. Our chart of the day comes from the EIA, and it's all about U.S. crude production in February. Here's the headline. U.S. crude output jumped 389,000 barrels per day in February. That's a solid recovery after the weather-related freeze shut-ins we saw earlier this year. Let's break down the numbers. Texas led the way with a gain of 246,000 barrels per day. New Mexico added another 190,000. But, and this is important, the Gulf of Mexico dropped 79,000 barrels per day and North Dakota fell 11,000. Total U.S. crude production in February, 13,626 million barrels per day. Year over year, that's up 386,000 barrels per day. Most of that monthly increase came from the Permian Basin and the Gulf of America. Now, here's where it gets interesting. This recovery, it was purely weather-driven. When you compare February to November 2025, production is actually down 163,000 barrels per day. The Permian, down. The Bakken, down. Gulf of Mexico, down. North Dakota, down on both a monthly and yearly basis. All indicators point to one conclusion: U.S. shale production has peaked. But, and this is crucial, we're not talking about a terminal peak here. Think of it more like multiple peaks over time. The question is whether current high oil prices will trigger another leg up. Our view, the oil majors operating in shale plays will show limited response to higher prices. You might see some pickup from medium and smaller companies, but here's the constraint. The futures curve is in steep backwardation. The 12-month and 24-month strips just aren't high enough to justify large-scale capital investment. Based on this, expect the EIA to report lower U.S. shale production for March. We'll be watching closely. Now let's talk gasoline because this story is developing fast. Last week, U.S. gasoline inventories plunged 6.075 million barrels to 222.299 million barrels. That puts stocks at the very bottom of the 5-year range, below the 5-year average, significantly lower than last year. We've been forecasting diesel inventories declining to record lows and prices hitting record highs. Now the question is, will gasoline follow the same path? Here's what's driving it. Strong global demand, international shortages, and critically, international prices are well above U.S. domestic levels. That means product exports remain robust and they keep drawing down domestic inventories. Gasoline prices are rising, but less sharply than previous weeks. The national average for regular unleaded just hit $4.30 per gallon. That's up 7.1 cents from yesterday and 1.12 higher than a year ago. Highest level since July 2022. Western and Pacific states have the highest prices. The Midwest and South remain lower. No major supply disruptions reported, and we're still below the mid-2022 peak of 502. Our expectation, U.S. gasoline inventories will continue declining in the coming weeks, supporting further price increases. But unlike diesel, we don't anticipate breaking the previous all-time record highs. Now here's the political angle. Sustained rises in both gasoline and diesel prices will trigger significant political backlash against the oil industry and the Trump administration. We expect President Trump to respond by pressuring U.S. refiners to reduce exports to keep more supply available domestically. That pressure could include explicit threats of export restrictions or bans. Stay tuned on that front. Let's talk about China because what they've pulled off here is absolutely brilliant. Bloomberg published a piece about how Chinese demand destruction is calming global LNG prices. The narrative goes like this. Oil prices have surged to wartime highs as hopes fade for reopening the Strait of Hormuz, but natural gas prices remain subdued despite significant supply losses. Why? Demand destruction in Asia led by China, which has sharply cut LNG imports. But here's what Bloomberg missed and what we've been telling our readers for years. China's decline in LNG imports isn't about market prices or the Hormuz disruptions. It's the result of a deliberate long-term strategic plan. China has aggressively expanded domestic natural gas production. Check. They've substantially increased pipeline gas imports from Russia, which recently hit record levels. Check. Economic growth has remained subdued. Check. This strategy is now paying massive dividends. Last July, we told readers that China anticipated the Hormuz Strait would be effectively closed, not by Iran, but by the United States. And that's exactly what's playing out. The U.S. Navy is blocking shipments to China that originate from Iran. Qatar can't export LNG to China. China's response? They moved quickly to secure an additional contract for a new pipeline to import more Russian gas via Mongolia. Separately, rising LNG prices have prompted several countries to switch back to coal. We've seen this pattern multiple times, but Bloomberg's analysis overlooks one critical factor. We're currently in the shoulder season. The market balance can shift rapidly with any significant heat wave in Asia or Europe, leading to a sharp rebound in LNG demand. Bottom line, China saw this coming, positioned accordingly, and is now sitting pretty while everyone else scrambles. That's strategic energy policy done right. The Wall Street Journal reports that the U.S. is seeking to build an international coalition to restore shipping through the Strait of Hormuz. The plan involves allies coordinating diplomacy, sharing real-time maritime intelligence, enforcing sanctions, and potentially contributing military support. Interesting timing considering President Trump previously criticized NATO and European countries for not doing more. European nations are developing their own security plans. Our take? We'll believe it when we see it. Here's a story that should make everyone sit up and pay attention. China National Petroleum Corp., China's top oil and gas company, pledged to prevent domestic energy shortages as the Iran war disrupts global supplies. Beijing is leaning on large oil reserves, increased domestic production, and diversification into coal and renewables. But here's what's really interesting. China has continued to aggressively stockpile oil even amid higher prices. Think about that. Oil prices are at wartime highs, and China is still buying aggressively. This raises one critical question. What does China know that the rest of us don't? We're wondering whether this statement came from officials observing energy challenges in other countries and questioning whether China could face similar disruptions. It may also stem from Iran's reduced ability to export oil, especially following the loss of Venezuelan supply. Regardless, China appears well positioned. Massive oil inventories, world's largest refining capacity, banned exports of petroleum products. They're not just prepared, they're fortified. All right, time to call out some bad journalism. Bloomberg published an article claiming the Iran war has split the Asian diesel market into haves and have-nots, with poorer countries facing severe shortages while wealthier nations remain well supplied. The article cites India as evidence of diesel shortages with service stations running dry. Here's the problem. This is highly misleading. India's diesel imports are virtually zero. Meanwhile, India remains a major exporter, shipping roughly 500,000 barrels per day. And here's the kicker. India's diesel exports in April rose year over year. So Bloomberg is citing India as evidence of diesel shortages, even though India is a large net exporter. The article's attempt to divide the world into richer nations versus poorer nations is equally flawed. They point to China as well supplied while conveniently ignoring that China has banned petroleum product exports altogether. Bottom line, this narrative falls apart under basic scrutiny. It cites India as evidence of diesel shortages despite India being a large net exporter while simultaneously pointing to China, which has banned product exports. The story simply doesn't add up. This is why you need to check the data yourself, folks. The U.S. Department of Energy announced billions in private energy investments in Central and Eastern Europe at the Three Seas Initiative Summit. This includes a new Trump Peace Pipelines framework to expand natural gas infrastructure and boost imports of U.S. LNG. Here's what this really means. U.S. LNG is not just a commercial product. It's a central pillar of American foreign policy and national security strategy. By expanding LNG exports, the U.S. has strengthened its position as Europe's primary energy supplier, successfully advancing the plan first articulated in 2014 to displace Russian pipeline gas in the European market. But there's a risk. Escalating trade wars, new tariffs, and U.S. efforts to secure influence over Greenland could undermine these gains. Combined with the ongoing Hormuz crisis, these developments could push European countries to accelerate their shift toward renewable energy and nuclear power at the direct expense of U.S. LNG imports. U.S. energy dominance isn't guaranteed. It has to be maintained strategically. Bloomberg reports that the Iran war has made it more profitable for clean fuel tankers, which carry diesel and gasoline, to switch to transporting crude oil. About 68 LR2 tankers have converted this year, bringing the total to roughly two-thirds of the global fleet. The shift is driven by higher demand and freight rates for crude carriers, longer trade routes, and reduced refining activity in the Persian Gulf. However, the surge has created a shortage of clean tankers, pushing up fuel shipping costs. Here's the important context. This trend began well before the Hormuz crisis. It was primarily driven by the large number of crude tankers sanctioned by the US, the EU, and their allies. As the fleet of non-sanctioned tankers shrank, freight rates rose sharply. Ship owners responded by shifting vessels from clean product service to crude oil transport. The Hormuz crisis only exacerbated an existing trend. Let's burn through some quick hits. Chinese solar manufacturers are posting fresh losses despite optimism about an Iran war-led boost to overseas demand. The problem? Weak domestic demand and massive overcapacity continue to pressure prices and profitability. The reported losses stem from operations in the previous period, nothing to do with the current situation. Oil majors are eyeing Canada's oil and gas sector as the Middle East conflict boosts its appeal as a stable supply source. Shell's $16.4 billion bid for ARC Resources signals this shift. But here's the thing, this has nothing to do with the Middle East conflict. Shell started looking at ARC in 2024. And finally, a Wall Street Journal opinion piece by Roger Pielke Jr. discusses how a highly influential climate economics paper published in Nature was retracted after major errors were found. New research shows the field's core methods cannot reliably measure the relationship between climate and economic outcomes. Yet these estimates have heavily influenced government policy, central banks, and financial regulations. We've been making this case for years. Climate policy has always been much more about politics than science. All right, that's the Daily Energy Report for April 30th, 2026. To recap the big themes, U.S. shale production has likely peaked, at least for now. Gasoline inventories are at the bottom of the 5-year range, setting up potential political fireworks. China's long-term energy strategy is paying massive dividends while everyone else scrambles. And always check the data before accepting mainstream narratives about energy markets. Thanks for listening. We'll be back tomorrow with more stories moving the energy sector. Until then, stay informed, stay skeptical, and follow the barrels.